Okay, it's 11 o'clock. We may as well get going. So our guest this week is James Armstrong from Bluefield Solar. And so we'll be talking to him in a minute. But first, as usual, a bit of news to run through. So I've picked out three things. You can see them there. Richard's off today, so I'll be covering Tritax Eurobox first. And the reason we're talking about that is because there's been another bid. So this is why the share price has been coming in towards the NAV. And as we know, this thing was hit quite hard because of the rising interest rates. That knocked valuations in the sector and that knocked an NAV. But before that, because people knew it was coming, the share price came off, and that's the reason why they're vulnerable to bids in the first place. Now, the cash offer that we've got, and it's a cash offer, this is the key thing, from Brookfield is 69p or 82.4 euro cents as it translates to, but 69p is the actual bid. And because we've got the certainty of cash, it's been recommended by the Tritax Eurobox board, and we'll come to that makes sense or not in a second. And it's a decent premium to the price that Tritax was trading at on the 31st of May, as we've seen from down here. But it's still a 12% discount to the last NAV. And my guess, and it's only a guess, is that the NAV will start to move up now as interest rates are coming down. There's still a big demand for what they're doing. That's the reason that Brookfield and Segro are both interested. It could be room for a counter bid because it's still a 12% discount. And it works out at a sort of net initial yield on the portfolio of about 5.1%. So here's a helpful chart. So Segro's bid is all in shares, and it's 0.0765 new Segro shares for every Tritax Eurobox share. And what we've got there in the pink line is the Brookfield bid, 69p, and the value of the Segro bid's been going down with the Segro price. And you can see it there again at the bottom as whether it Brookfield price is discount or premium. And at the moment, where the Segro share price is, it's a hair-free premium. Now, we see this a lot, and particularly big M&A type deals like this. You get a lot of people playing around in it. Merger arbitrage people, they'll sell the bidder, buy the offeror, and try and take a profit when the deal actually goes through. And that drives down the price of Segro, and that's obviously drives down the value of its bid. So it is possible that if you went for the Segro option, the share price might rally, and that you might get back into a profit again. But at the moment, Brookfield is a better option, and I think the board is saying we like the certainty of having cash. And so it seems to me that if Segro wants to counter, they might have to put a cash element into their bid. But we'll just have to wait and see what happens with that. Digital 9, I wanted to mention because it's appointed a new manager this morning, and that gives a lot of clues to what the board's thinking about in terms of the wind down process for this. Now, the first bit of information that we've got here is a fixed fee thing, which makes sense. But it's for 3 years, which is a long time, way longer than I think most of us were hoping that we'd take to get this done. And the fee drops after 3 years, so there's a kind of penalty if it drags on longer than that. But nevertheless, 3 years is a long time. There's a deal where they have to reinvest 10% of that in shares. I think that's by the by. It's sort of sensible thing. And then there's a sort of token fee after they've sold everything before they delist it, which sort of makes sense. Then there's also a performance fee. And again, this is quite instructive. So the NAV is 45.7p, just shy of 400 million. And the sort of fee kicks in after 225. So it really is not very ambitious. That's 26p, so that's not too bad in terms of where the share price is now. If you got 26p, but of course it takes 3 years to get there. That's not great. Then it kicks up again over 300 million, well, 34.675p. So that it doesn't seem to be particularly ambitious. It's basically saying there's no hope of getting the NAV back. That's the implication. So I'm disappointed by all of this. It just seems very unambitious, way too long. It does mean that there's if you did sell stuff for NAV, and I know that's a tall order, but the NAV has been marked down a long way. Remember that. if you did sell stuff for NEV, you're handing 0.8p to the new manager. So yeah, all not good. But then that never was. UIL, talking of not good. This is a bit obscure, I think, for most people. Most people don't heard of it or looked at it and thought dismissed it because it's too small. It also doesn't perform very well. You can see that on this chart here. It's a 10-year chart. And the discount is pretty wide and always has been. And there's nobody coming over the horizon to bid for this because it's controlled by one shareholder. It's just put out some results and they're not very good again, and the NAV dropped again, and the discount widened. And the board said this is not great. There's also very low liquidity in the shares because there's very low free float. The fund isn't big enough to do what we want to do with it. So we think the best option is to take it private. And they're going to work towards selling the portfolio, I guess, enough to fund the redemption of the zero dividend preference shares. Now, it's quite unusual in this because it's one of the few funds that's still stuck to using zeros. It's got one issue there in the 2024 one, which is about to roll off. And then it's got ones that mature in 26 and again in 2028. And you can see it's pretty heftily geared with these zeros. And that, again, has been part of the issue with why people haven't really warmed to it. So they need to find the cash to finance these HPO redemptions. And that's been the focus of all of the past year. It's been, can we finance the redemption shares in 2024? And they've done that. They pulled that together. And that will happen pretty soon, really, because they're mature at the end of this month. It's also a very weird portfolio. It's a real odd collection of financial services, technology, mining, all sorts of stuff in there. You can see that from the sector split and a lot of names in there you've never heard of. Some of these are listed, some of these aren't listed. They've already started the process of sorting out the portfolio. So one of the things that they've done since the announcement came out about the results is they've swapped the minority that in Zeta Resources for cash or new cash by way of new shares, and the Tritax Capital. So that's gone out of the portfolio, and so now this UIL owns 100% of Zeta Resources Limited, and the potential of that would have gone up. So there's there's a limited options here as to what you could sell off to free up some cash, but these things are chucking up some cash as well, so there may be opportunities. It does raise an issue about the UIL stake in Utilico merging, whether it wants to keep that or not, and that's one of these things to bear in mind as we go on over the coming years. We do this zero preference share sheet every month. It's got smaller and smaller and smaller, and UIL's been a big part of that. So this one, as I say, is about to mature through this October. But the interesting thing, I think, is where these other two are trading. It's aggressive to turn a lot of that, so much stuff to cash to pay all of this stuff back. But it seems very likely to me that they're going to be able to do the 2026 one at least without too much hassle. And so those zeros offer you, between now and redemption, and an annualized yield of 10.7%. That doesn't look too bad to me. So if you wanted to play this in any way, shape, or form, rather than fussing about in the ordinary shares, this might be the way to go.